these are actually two different types of expenses, even though it seems like it'd be the same thing. Transportation expenses has to do with expenses that are incurred locally, essentially. So if you're an accountant and you do bookkeeping for a client and you're driving during the day to the client's office, because it's during the regular business day, that's considered to be a transportation expense. I'm sorry, yes, and a transportation expense, sorry. Travel would involve some sort of overnight, okay? There's a distinction between them because for transportation expenses, you're not allowed certain deductions. For travel expenses, you're a little bit more, you get a little bit broader choice of the deductions that you can take. Now, these are only for trade or business expenses. If you're a W-2 employee, you don't get any of these. You get reimbursed from your employer, right? Because you don't get any deduction. It used to be that you would maybe get some deduction. It was a 2%, it was an itemized deduction that was subject to 2% of your adjusted gross income. So you should be able to kind of think about what that is, because we talked about medical expenses in the same way, and we talked about charity in the same way. It's got to exceed a certain amount of your, the casualty losses as well. The miscellaneous deductions used to be that way for W-2 employees, but we don't have that anymore. That's another one of the things they took away with the new Tax Act. And I call it new. It's been almost 6 years. It's not really new anymore. So again, transportation, expense of getting from one workplace to another workplace within the home area. Okay, so we're talking about a localized area. Travel generally refers to business travel away from home that requires an overnight stay. And there is a difference in how these deductions are calculated. First, we're going to talk about transportation expenses. So we have to define we've got this concept of tax home, which is the taxpayer's regular place of business, regardless of whether they actually live there or not. So, for example, if let's say I'm self-employed, I live in Ames, but I have a business in Des Moines, my tax home for transportation purposes would be Des Moines, not Ames. Go a little bit further afield, maybe I had an office in Kansas City that I go down to, I go there for a week and come back on the weekends, that sort of thing. Kansas City would be my tax home for transportation purposes. Mileage between your actual home and your place of business is not deductible. That's considered to be commuting, okay? So, and that's true of whether you're self-employed or a W-2 employee. You don't get, so I live in Ames, I drive to Ankeny. If I was self-employed, I drive to Des Moines as well. If I was self-employed, I wouldn't get to deduct the mileage between those two locations because it's commuting mileage, right? However, if I am driving, and this is kind of a handy little chart, by the way. If I am driving, let's say my tax home is here in Ankeny and I'm self-employed, but I go to Des Moines to visit with other clients. Essentially, that client office is considered a temporary work location for me. And my mileage between those locations is deductible. So between home and your regular or main job, never deductible. That's commuting, that's never going to be deductible. From your regular or main job, or your tax home for transportation purposes, and a temporary work location, which is like going to a client's office to do some work, that is always deductible. Also, if you have a second job, as long as it's a self-employed second job, because you're not going to get a deduction for the if it's your W-2 employee, between your regular job and your second job. So I'm an accountant, but I also own a bakery. I don't actually, but going between those two, would be deductible. Also, going between my second job and a temporary work location is also deductible. Okay? But going again from my second job to my home is not deductible. Okay? If I go from home, though, to a temporary work location, so I'm going from my home down to Des Moines to my client's office, and my regular place of employment is Ankeny, then my drive from my home to that temporary work location is deductible. Okay, so it's as long as I have my main job is in another location. Again, this only pertains to self-employed individuals, not to employees. Okay. Let's see. So, yeah, your home is wherever you reside. Sometimes that can even be tricky. Well, you know, the tax code is, I mean, it's kind of funny because I think I mentioned this right at the start of this class that, you know, it's based on relationships and how humans interact with each other and how humans work, and that's not always very clear cut, right? So again, even defining something like what is your home can sometimes be difficult to do. And tax court cases come up with arguments of, yes, this was my home. No, that wasn't your home. Yet, you know, and looking at all the facts and circumstances. You know, if you've got multiple homes, then it may be an area that is, you know, where there's some disagreement. So here, let's see. What are we doing here? Oh, insurance agency. What is Alan doing here? Oh, I think this is part of the, I'm sorry, this is part of the tax, the software thing? Yeah, so this is kind of an extended example. I don't know if I want to go through this or not. I'll let you go through that if you want to look at it. I'm not going to go through that one. That's taking up too much space, too much time. Okay, so depreciation and amortization, this is the form that we use when we are depreciating, when we're using bonus depreciation, when we're taking 179 deduction, all of that stuff. This is the form that we're using. You can see the first section, part 1, is if you are electing section 179 expense up here. The maximum, and I think you have a tax return problem that includes some section 179 expense, either in this chapter or one of the comprehensive problems. I think there might be one in this chapter. So maximum amount, it says see instructions. I think this is the $1,080,000, because that's the most that you could take, $1,080,000. And then the cost of the 179 property that was placed in service. So whatever you placed in service, that would go on line 2. I don't think we put anything there. Reduction, so subtract, if there's any reduction, subtract line 3 from line 2. I think in your case there's no reduction. Description of the property, cost of the property, what cost are you electing for section 179? Because remember, you don't have to take all of the one, you can divvy it up between 179 and regular maker's depreciation. So you might have a cost of $100,000, but you're only going to take $50,000 in section 179 deduction. Any listed property is listed separately. Now it says enter the amount from line 29. That's because on page 2 we have a section for listed property. This is where like automobiles would go, cell phones would go, that sort of thing. I think you do have a section here. I think one of your problems as well, you do have to list something in the listed property. You've already looked at it. So this is where your automobile, again, description, type of property, when did you place it in service, what's your business use? So in this example, 90% says up here, say, so he put an automobile into service on July 15th. Now again, we'll start depreciating it as of July 1st, because more than half of the assets weren't placed in service during the last quarter of the year. But we have to put the date that we placed in service on the form. 90%, so it's not 100% used for business, but we're over that 50% threshold. So we can use our regular maker's depreciation. Cost us $22,000. So we're gonna take 90% of that 22,000, okay? This is the depreciation method that we're gonna use, 5 years. DDB is double declining balance, okay? That's what that, so 200%. SL, straight line. So that's our building here is straight line. So he took no 179 or bonus depreciation because less than 40% of the aggregate basis was purchased in the fourth quarter. The mid-quarter convention is not required, right? So he's good. He purchased everything in July. He's good. So current year depreciation, we'll be using that table in the book and applying the, so these would all be 5-year properties. The phone system, the computer, and the automobile, that's why it's at 20%. Furniture is 7-year. Office building is gonna be a 39-year property. Be using the tables to calculate how much that is. Again, this automobile, so we've got 22% times 90% business use times the 20% for the depreciation. This is our total depreciation expense for this year. Let's see. This is what it would look like then. Now it'd be nice if they gave us an example where they did the 179 deduction, but they didn't do that. So in this case, part 1's not filled out. Part 2, if we have any special depreciation, that would be listed there. So special is bonus depreciation. Maker's depreciation. Now, this is a little weird. This line 17 is kind of hidden here, and sometimes it's easy to forget about. But this line 17 is if you had any assets from prior years that you're still depreciating. The total amount of depreciation for all of those assets goes here. So, you know, we say we had $100,000 of depreciation from last year. We're gonna depreciate 20% of it. That's various assets. So we've got $20,000 of depreciation from last year's assets. We put that in here. Everything else is current year assets, whatever we purchased this year, okay? Last year, any previous years, it all goes there. Line 17. Okay, so now we've got 5-year property, which is totaled up. Basis for depreciation, 7-year property, 23,000, let's see. So our 5-year property, what do we have here? So the computer and our phone system are 5-year property. Automobile is 5-year property, but it's listed property. So it's gonna go on the back page of this form. That's why it's not included down here. So this is 4,800 total. That's where this 4,800 goes. 5-year property, 4,800, 5-year, half-year convention, double declining balance. So we could choose straight line if we wanted to, but we're not choosing that. So we did our calculation for the depreciation deduction, enter it in there. 7-year property, this is our equipment or furniture, I can't remember which it is. Again, double declining balance. Half-year, we looked at the tables to determine what our depreciation deduction is this year for that. Then we also down here have our real estate, non-residential real property, office building, over 39 years, 120,000, and there's our depreciation deduction. Now, remember, this is the date that we placed it in service, but this isn't necessarily this isn't the date that we're using to depreciate it from, right? We're gonna use whatever convention we need to use for determining what our start date for depreciation. Listed property is going to come from the other page, and it gets entered there. So, oops. So this line 21, so when you're doing your tax return problem, use this to kind of as a guide to help you out. Listed property, again, that's coming from the other page, which we'll look at here in a second. And then the total from line 12 and 14 through 17. So line 12, wait a minute, no, 12, 14 through 17 plus lines 19 and 20 in column G. Okay, so there's column G, line 19. So this is, let's see, where we go here, and line 21. Okay, so this is essentially everything from here and here totaled up. That's our total depreciation deduction. Now we do have page 2 over here. This is where we calculated the depreciation on the listed property, that automobile. Totaled that up here. That's what then gets transferred. That's line 28. That's what then gets transferred right here onto line 21 to be added in with the other depreciation. Don't need that. Amortization, so there is, if you have an asset that you're amortizing, remember amortization is for any intangible asset. Yeah, that total, so this again, during 2022, this year would be on line 42, any prior year amortization is on line 43, and that gets entered on line 44. I don't think you have anything, you don't have any amortization in your problems. If the 179 election were made, all of that personal property you could elect the 179 on it, not the building, right? That's separate. But all of it would be deductible, and then that would go on part 1 of the form up here. Let's see, what else do we want to see here? All right, so local transportation, and this is essentially, this is the same thing that infographic is saying here. Getting from one workplace to another in the course of conducting a business or profession, when traveling within the city or general area of the taxpayer's tax home, visiting clients or customers, going to a business meeting away from the taxpayer's regular workplace, getting from home to a temporary workplace when the taxpayer has one or more regular places of work. These temporary workplaces can either be inside or outside of the taxpayer's tax home. So oftentimes what that is, and I would have clients that would do this, they'd have an office. I had a client that was a counselor. She worked from home, she had a home office. She also had an office where she met with clients. And so she had 2 places of work. So in that case, she actually was able, because she was going from one place of work to the other, she was able to deduct that mileage from her home to her office where she met with clients. So that's an example of when, and you can, I mean, there are ways to swing that. Let's see. Catalina, self-employed computer analyst in Atlanta. She maintains an office at the downtown location, but she lives 30 miles out of town. She's currently performing a job that will last approximately a week. It's 45 miles on the other side of Atlanta, so 75-mile one-way trip from her home. Because this is a temporary work location, she can deduct the cost of her transportation from her home to the temporary location. Okay? So the advice is, if you're going to a temporary location that is further away, then go from your home to that temporary location. Don't stop at the office first, right? If it's further away, or if it's not further away, then stop at the office first. Because then you can deduct the, yeah. Well, it would depend. Anyway, I'm not gonna go through what types of expenses can we deduct? Right, again, we're talking about transportation here, so mostly automobile, especially transportation expenses, we're talking about automobile expenses, right? Flights and things like that, that would be considered travel, and we'll talk about that in a minute. But automobile expenses, so there are two different ways that you can calculate this. One is the standard mileage rate, and one is actual expenses. Either way, you have to keep track of mileage. Whichever one you choose, you have to keep track of mileage. If you use actual expenses, so you gotta keep that log, one way or the other. If you use actual expenses, you also have to keep all of the receipts. If you use the standard mileage rate, the mileage rate assumes a lot of those expenses. It assumes the depreciation, it assumes the cost for gasoline, it assumes the cost for maintenance on the car and tires and stuff like that. There are certain expenses that are not wrapped up in that, like registration fees, annual registration fees, interest on any car loan, that would not be included in that calculation, but it includes most automobile expenses, okay? Now in 2022, the rate was 58.5 cents per mile. Now, it changed during the year. I think we had another instance where it changed during the year. It changed for business mileage as well. It started out for the first half, it was 58 cents a mile. Second half, it was 62.5 cents a mile. How much is it right now? Does anybody want to look that up? I can't remember exactly. It's more than 62. And gee, gas prices, yeah, and everything else.
65.5.
65.5 cents per mile. So again, you drive 1,000 miles, that's a $655 deduction that you get. If you're in the 30% tax bracket, now you've just saved 315-ish dollars, 317.50, something like that, on your taxes. So it's definitely worth it, right? It's absolutely worth it. The taxpayer can use the mileage rate if they own the vehicle and they use the standard mileage rate for the first year it was placed in service, or they lease the vehicle and they use the standard mileage rate for the entire lease period. In most cases, when you choose one or the other, you gotta stick with it, okay? Because you can't use the standard mileage rate and then switch to depreciating it, because you've already depreciated part of it that was wrapped up in that standard mileage rate, right? It cannot be used if the auto has claimed depreciation other than straight line, 179, or bonus depreciation. If the taxpayer operates 5 or more cars simultaneously in business operations. So if you have a larger business where you've got a delivery business and you've got like a fleet of 10 vehicles, you can't use the mileage rate on those vehicles. This is mostly for smaller businesses and sole proprietorships where they'll use it. Let's see. Pretty simple. You just calculate the miles and multiply it by whatever the rate is. You do have to have certain information. You still have to list the date that it was placed in service, the miles that it was driven. There are certain times though you don't have to, if you don't have any other business assets, then you don't have to use this 4562, you don't have to fill it out. The information is placed. If you don't use the 4562, then I don't know if you remember on the Schedule C, there was a section on the second page, the back of that asked about vehicle information. That's where you would put that information. But if you do have to use the 4562, you would still put it, let's see, you would still have to enter this information in, but you wouldn't have a depreciation deduction in that case. You would put the mileage on the Schedule C.
So, in one case, if somebody is Uber, like that, because the Uber, then
Yeah, Uber driver, yep.
So, it's supposed to track for mileage. Excuse me, if somebody don't know and they make your tax and not deduct expense, it can deduct next year's because you don't know.
No,
Because a lot of people stay in a 1099 and don't have a expense deduction for mileage.
right, they should keep track.
Yeah, because it's don't track, you don't have no information for that,
Yes,
so.
exactly, it could be denied, if they claimed it and didn't have the substantiation, then the IRS can come back and deny it. Even if it's legitimate, like even if it was real mileage, if you don't have the log, if you don't have the substantiation, the IRS can deny it. If you get audited, again, there's a lot of ifs,
Okay.
so,
So how long do you have to keep that log?
as long as the tax return could be audited, which is generally 3 years.
Okay.
Yep. Let's see. So like the Uber driver,
Yeah.
here's the thing about the Uber driver. So that first trip of the day, that is commuting because you're from your home to your first place of work. All the other trips are business,
Yeah.
but then that last trip of the day is commuting. So you wanna make sure, if you can help it, not to have a short trip for that first trip of the day.
Yeah, because I guess I'm telling you something because I have my lot of friends don't know this one.
Yes.
And then
Yes.
I'm trying to explain that, this one you guys supposed to take money out of the tax because
Mm-hmm.
this one different case because 1099 everything you do is supposed to take it back.
Yep.
you know.
Yep.
Oh, it's okay. I want to figure out.
Yeah. Yep, so your friend can,
Yeah.
for 1099s, and Uber is, I mean, that's a big chunk of,
Yeah.
that would be their major expense, would be, mileage.
Not
Let's,
depreciation.
well, you get to choose one or the other. So we're talking about the standard mileage rate here. If you choose to depreciate, that's the actual expense method. And but you can only do one or the other, you can't do both. So you can still deduct interest, so if you're paying on your car and you borrowed, you can deduct the interest on top of the mileage rate. You can also deduct, parking fees, tolls, and property taxes. Registration fees would be those property taxes, so those would be separate from the mileage rate that you can then deduct, but everything else is wrapped up in that mileage rate. And it's, the intention of that is to simplify. Did you have a question?
I guess I'm just thinking, so like if they make $150,000 a year
Mhm.
and it's all driving and they deduct all of that mileage, do they?
Well, if they have that much an expense, yeah,
Right?
yeah.
So they can deduct all of it and then they wouldn't have to pay taxes on the $160,000 that they made.
If they incurred $160,000 worth of expenses. If you're using the mileage rate though, $160,000, what is it, divided by 0.655, whatever that is, that's a lot of miles.
Wait, wouldn't it be 60?
It'll be like about, what, 250,000
Hold on.
miles-ish?
If they make 160, wouldn't it be divided by the 62.5 though? Cause that's how many cents it is per mile.
Well, in 2022 it was, but you just said it was 65 and a half.
Yeah, so
Yeah.
wouldn't it be 65.5 or would it still be 0.0655?
It would be 0.655 per mile.
They'd
And that's the
Oh.
deduction.
yeah, they'd have to drive 2 million, little
Well,
over 2 million miles.
Probably 200,000 some miles to get $160,000 of,
0.655 or 0.0655?
0.655.
Oh, so 244,000 miles.
Right. Right. 244,000 miles is what they'd have to drive to get $160,000 of expenses that would then offset all of their income. Right. Exactly. Always better for employees though to get reimbursed, right? Because as an employee, you don't get this deduction, right? So otherwise, your employer's just getting a free, a free pass on all this. Of course, they don't have the deduction for you, like when they pay you, they get to deduct the expense, but the employee doesn't. Let's see. So here we've got Ed purchased a vehicle for business and personal use 2022, he used the vehicle 60% for business, incurred 14,000 miles throughout the year. Okay, so that means 7,000 at the beginning of the year, 7,000 at the end of the year. Used the standard mileage rate to calculate his vehicle expenses. He also paid $1,600 in interest and $180 in county property tax on the car. So, this is how we would calculate his expenses, his deductible expenses. Let's see, 60% for business. Okay, so we'd have to take the 14,000, we have to multiply that by 60% to get the business portion of the mileage, right? Ideally, what you wanna do is have in that log a beginning odometer reading and an ending odometer reading, and then every time you use it, and there are apps now that you can use, you just, push the button whenever you, and that's probably what Uber, I would imagine Uber has an app for their drivers in order to keep track of that. So 60% of the 14,000 would be business miles, but they incurred half in the first half of the year, half in the second half of the year. Now, luckily, most years we don't have a change in the middle of the year, but last year we did. That rate can go down too. Very rarely does, but I have seen it go down. I have actually seen it go down. Standard mileage rate, 1,600. Okay, so here's so 7,000 miles times first half of the year, 58.5 cents per mile, 4,095. They shouldn't put, well, that comma, that should be a semicolon just to make it more clear. Then second half of the year, 7,000 times 0.625. Now what they're doing here is, I think they're taking, they didn't take 60% here. Did they take 60%? I don't see that they took, unless, maybe this is all business miles. I read that as though it was his total miles were 14,000, but that might be business miles. I guess we'll assume that's business miles because that's the calculation they've done here. No, it isn't. 4,095 plus 4375 is not 7840.
Here you have two rates. You have two rates. So 14 over 2 is 7.7. We have two rates. 0.5 and 0.6 is not the same rate, I think.
No, but I'm saying, so this would be the first half of the year, the calculation, 7,000 miles. This would be the second half of the year. I'm assuming these numbers are correct. Maybe they're not, I don't know. But then you would add these two together, which would be over $8,000, right? So, I don't know what this is. Unless, like I said, maybe this isn't right. Anyway.
It's a lot of mistakes this book is making.
Well, you know what they do is they update it every year, and then I'm sure they miss certain things when the rates change, because these changed from the year before. So, but you're right, they still should not happen. Anyway, that's what the calculation would be. Yeah, whatever this is. My guess is 7840. Like, what's 7840 divided by 14,000? 0.56?
Yeah.
Exactly. That was the rate for the year before. They just didn't change this for the new rate. But anyway, these two would be the total. And then we would get to take 60% of the interest, that's the business portion, plus 60% of the property taxes, that's the business portion. And we would add all of those together, so it would be more than this. The additional, or the remaining $72 of the property taxes we could put on the Schedule A as a state and local tax if we're itemizing our deductions. So you could take the whole thing, but it would be in different places on the tax return. Now the beauty of it being here is that it not only offsets income tax, it offsets self-employment tax. So Social Security and Medicare tax, which if you recall from payroll tax is 15.3%, right? So you get a bigger bang for your buck if you can get deductions on your Schedule C as opposed to on your Schedule A.
Sir, excuse me. For the mileage on C, it take 100%. It's not take 60%.
Well, yeah. See, I took this as this is the total miles, but they don't really say that there. It looks like they're assuming that this was the business miles. Like the 14,000 was the
Yeah,
business miles.
because on the, up there, on the
Yeah.
60% for business, so this does mean 40% is not for business.
Right.
Here, if somebody take, because 17 is 14%, 1,400, so that means 100% for business.
Well,
Because
Yes,
that's what I
if-
see.
you're talking about the 14,000.
Yeah,
So even though they're not clear on, is this the total miles or is this the business miles?
Right.
They're not clear here. They've calculated it as though all 14,000 are business miles, which means they would have, 40%, well, more than 40% of, so I don't, divided by 0.4, 14,000. So maybe 20,000 total miles, something like that, and 14,000 was for business. They weren't clear though in that problem.
because you tell us, and for some example like that, you're supposed to see the portion and then you want
Yeah.
to make sure
Yeah.
you cannot do mistake, because
Right.
right now, if you take 100% off and take
Yes.
60%, it's
Yeah, yes, because then you'd be taking 60% of the 14,000. Right, absolutely. They're not clear in this problem. It's a terrible problem. All sorts of mistakes. Okay, the other option is to use actual expenses. So this means you gotta keep track of all of those expenses, all the gasoline, oil changes, maintenance, tires, everything that you put into it. You still have to keep track of the mileage though too, because you've gotta figure out how much of those actual expenses are business expenses. And you're gonna use that mileage to calculate that. So, depreciation, in this case, you do get depreciation though. So you can depreciate whatever that business portion is of that vehicle. Gas, oil, tires, repairs, insurance as well, you can include in this, licenses, registration fees. It would also include, interest payments on loans and that. Now, I had mentioned that you can't, if you've used the mileage rate, you generally can't then switch it to actual expenses. You can if you then have to go back and reduce the depreciable basis by 20 cents a mile, you've gotta make an adjustment, because that 26 cents a mile, that's the calculation for depreciation in the mileage rate. Okay, yeah.
I thought under ordinary, necessary, and reasonable expenses, payments for fines and penalties, well, I guess a fee.
Yeah, the fees would not, that's like a tax. So the registration fees, if you were late in paying your registration fees and they tacked on a penalty, then that amount would not be deductible.
Yeah,
But yes.
well, it's just that one of the examples that they had was, like this guy needed a state permit.
Mhm.
That was $2,500, and the maybe they were saying that the $50, cause he said he'd rather pay the $50 ticket.
Right. So I know what example you're talking about. There's $2,500 registration fee or whatever that would be deductible,
Okay.
but to him,
$50 ticket.
it's a $50 ticket. If he gets caught, the $50 isn't deductible,
Right.
but that's a better deal than paying $2,500 for the, yeah.
But you'll get it back at the end of the year if you deduct it, right?
You would, but again, it's only gonna be it's gonna be a percentage of that. Again, it would depend on your tax bracket, but chances are, that's such a big difference. There's probably no scenario where it would be worth it to pay the 2,500, unless they said, you only get 2 and then we're gonna take we're gonna impound your truck or something like that.
Okay.
That's a pretty extreme example that they gave. Usually, they're gonna make it worth it for people to pay those fees.
Okay.
But yeah. Actual expense method usually results in a larger deduction, but also requires receipts for actual expenses as well as that mileage log, which you have to keep either way. So only the mileage documentation is required if you're using the standard mileage rate. But also remember that depreciation, if you keep your vehicle for more than 5 years, that you're gonna run out of depreciation. So a big chunk of that deduction is gonna go away, right? And then you have to keep using that as actual expenses. If you have the same, now I don't know how many people actually keep their cars for 5 years these days, but of course at the same time it's difficult to pay off a car in 5 years. Okay, so I think we've got time to finish this up. Travel expenses. So that's transportation, that's all local expenses, right? Travel expenses would be incurred for overnight stays. So example, you're going to a conference and you're flying to New Orleans for that conference, that you would then be incurring travel expenses in that. Maybe you're gonna fly, you gotta pay for the conference itself, you gotta get a taxi, you're gonna have, now notice with the transportation, we didn't say anything about food. Unless you're taking a client out for a meal, the food during the day would not be deductible. So even if let's just say you're driving, you're gonna go to your client's office, you're going from one work location to another work location, you swing by Chick-fil-A on your way there, through the drive-through, that is not deductible. That's just your personal expense.
But
Now-
what if you bought lunch for you and the client?
But if you were there with your client and you were and you were having a conversation about business, then that makes it a business meal. So, but for travel expenses, meals are included. So again, it involves an overnight stay. Even things like dry cleaning expense are deductible. So if you have to, you've got to sit for your big presentation and it's all wrinkled when you unpack it, you got to send it off to the dry cleaner to get it cleaned up, you can deduct that if it's a travel expense. If you're at home, you cannot deduct it. It has to be associated with travel. But meals, lodging, other incidental expenses. All travel expenses can be deducted if the trip was entirely business related. There's no personal component to it. Here we've got Alba, self-employed, has her primary business in New York City. She flew to Washington in the morning for a business meeting, then flew to Boston for an afternoon meeting, and then took a late flight home that evening. This does not count as travel because it all happened in the same day.
Wow.
Okay, so even though she's flying on, now she would get to deduct the flights, the cost of the flights. That's a business expense, but her meals that she incurs during that, she would not get to deduct that. So in reality, the expense might be about the same, or what's deductible might be about the same. It's just that those meals would not be included in that.
So, excuse me for a second. So if you fly and then you can take hotel or something like that.
Hotel would be deductible as well. Yep. It's just when it's an overnight, then you've got that potential for meal expenses to be included in it, and dry cleaning. Do that. Okay, so temporary work assignments. So if a temporary work assignment can be expected to last less than a year, then travel from the tax home to the work assignment and temporary living costs at the remote location are deductible. Years ago, I had a client who had temporary work assignment in North Dakota. He worked on the oil fields up in Minot, North Dakota. He was able, because it lasted less than a year, he was able to deduct his mileage from Iowa to North Dakota, and all of his living expenses, and all of his meals, all of that stuff was included and deductible. Now, at the time, he was a W-2 employee, and at the time, those miscellaneous itemized deductions were allowed. Now, he would not be able to deduct it because those are, if he was a W-2 employee. If it was a 1099, then he would be able to deduct it in that case. So even in those extreme circumstances, that you can, a lot of those are deductible. So if the work assignment is expected to last longer than a year, then the position is considered permanent. In that case, your tax home has changed, and those expenses then are no longer deductible to you. So, also, we've got this reasonableness limitation. If the trip is partly personal, or if it's lavish or extravagant expenditures for meals or lodging. So, again, that's that reasonableness, and reasonableness is kind of vague. One person's definition of lavish is different from another person's definition, but it would all come down to mostly what the IRS thinks is lavish, or the courts.
Random question.
Mm-hmm.
I don't recall if you answered this or not, but isn't an Uber driver, would they fill out a 1099 or a Schedule C?
So they would receive a 1099 from Uber, they would fill out a Schedule C.
Okay.
Yep, they would report that on Schedule C. Okay, so sometimes we have trips that are a combination of the two, right? A combination of business and personal. That happens a lot, right? You've got a conference down in Orlando, you decide, hey, I'm gonna take the family, we're gonna spend a couple days at Disney World, and combine the two. Well, in that case, you do have to apportion the business part and the personal part. It gets a little tricky when it's like, what do you do with the travel expenses? Like, are they for if you're taking your family, the expenses for your family are not deductible. They're not business expenses unless they work for you. But the expenses for you, like your plane ticket, if it's partly personal and partly business, how do we figure out if that plane ticket is personal or business? So what we have to do is determine the number of days that are personal and business. So if the trip was primarily business related, even if some personal vacation was involved, then the taxpayer can deduct the transportation expenses, meaning the expenses for getting there and back. So it has to be primarily business, though. If it's primarily personal, then you're gonna have to apportion it out. So here we've got Timothy, self-employed, Raleigh, North Carolina, personal financial advisor. He flies to New York to visit his parents for 7 days. While in New York, he rents a car to meet with a business client one afternoon. And this is where a lot of clients can get themselves into trouble. They think, okay, well, I've got this vacation plan. I'm just gonna add a business component to my personal vacation. I'm gonna deduct it and call it a business expense. You can't do that. The rental car and costs associated with the business meeting would be deductible, but the flight of the cost is not, because it was primarily personal in nature. Now, if he spends 5 days in New York conducting business, and then he drives to his parents' house for the weekend for 2 days, now the trip is primarily business. Transportation expenses would be deductible in addition to the meals and lodging while he's on business. So the 2 days at his parents would not be deductible as far as meals and lodging, and any expenses to get to his parents would also not be, because that would be personal. But the transportation itself to get there, because it's primarily business, that would now be deductible. Some different rules with regard to international travel. I think you have a homework problem that concerns this. If I recall, I've had a lot of students that have had questions about that. It changes a little bit every year, that problem, but I always assign that one. So anyway, so if it's foreign business travel, trip is considered entirely for business if it meets one of these criteria. So if the taxpayer does not have substantial control over arranging the trip. So, I mean, it's hard to imagine that as a 1099 employee or a 1099 contractor, but if, you're working as an architect for some company in Germany and they fly you over, but you've got to pay for it. But they say you've got to be here, and here's our travel agent, make your arrangements through this, that sort of thing. You don't have really control over arranging the trip, or they arrange it for you, but they ask you to pay, which sounds really weird. I'm not sure that would ever happen. But anyway, taxpayer does not have substantial control over arranging the trip, or the taxpayer is outside the U.S. no more than 7 consecutive days, You do not count the days on which the taxpayer leaves or returns. I'm emphasizing this because this is part of your problem. Okay? So you don't count those days. So the day that you fly out doesn't count. The day that you fly back doesn't count.
What if it takes multiple days?
Yeah, the travel days would not be included.
Okay.
Taxpayer spends less than 25% of the time on personal activities. The days on which the trip began and ended are counted in calculating that 25%. Okay? Which means that's actually giving people the benefit of the doubt there by including those, because that's the denominator. You were gone 10 days, including travel days, and you spent 2 days on personal. That means it's 20% of the time rather than 2 days over 7 days or 8 days. Does that make sense? So less than 25% of the time on personal activities. Or vacation is not a major consideration for the taxpayer. So you're not there for vacation. You're going over to Germany to do some work for a client, and you're staying in Munich, and you're very close to Austria, and you love the sound of music. So you decide to go on a tour of Salzburg, which is like 30 miles away, something like that. But you're there for business, right? That sort of thing. All right. If one or more of the conditions are met and the trip to the foreign country is considered primarily business, then the taxpayer still has to allocate travel time between the business days and the non-business days. So to calculate the deductible amount of the round-trip travel expenses, the taxpayer multiplies the total trip cost by the fraction of the number of business days to the total number of travel days outside of the U.S. Weekends and holidays are considered business days, so you got the advantage there as well. If a vacation is taken beyond the place of business activities, the travel deduction is limited to those expenses to and from the business location. Okay, so a little bit different rules with regard to foreign travel. Meals and entertainment. We can get through this in the next 5 minutes here. So, this has changed kind of back and forth over the last few years. For a long time, meals were always limited to 50% of the total. So if you got spent $100 on a client meal, you could only deduct 50% of it. And the software always handles that as well. Like you'd put in the total and then it would calculate 50%. Well, with the pandemic, they wanted to encourage people to eat at restaurants, or at least order from restaurants, right? So they changed that deduction amount to 100%. But it was only for 2021 and 2022, okay? So business meals deduction is 100% for these 2 years. So for our years that we're dealing with our problems, that would be 100%. I don't think they have changed it back. Again, that would require an extension of it. And who knows what would happen. Entertainment really isn't deductible anymore. It used to be that it was also deductible at 50%. So if you took a client out for dinner and you took them to the opera, you could deduct the cost of those opera tickets, but you can't anymore. You can deduct the cost of the meal, but not the entertainment part of it. Also, club dues and membership fees are denied. You cannot have, so country club memberships, a lot of businesses used to provide country club memberships for their employees. They would be able to deduct that. You can't deduct that anymore. Even if you're a member of the country club in order to do business, which people will do that. They'll join these, organizations and places in order to network, right? But it is not a deductible expense. Meals, while away from home, can be deducted. Again, you've got to keep track. You've got to keep receipts for them. And here's where you can use the actual cost or a per diem rate. So I think maybe it was the the other class. I had a question about per diem rates. Now the per diem rates, these are called CONUS rates, that continental US rate, they are preset by the federal government. This is the amount that they reimburse their employees for, if they travel. But there's also, so there's this standard rate, and this $155 a day would include lodging and meals and incidentals, so it'd be combined. I don't know where, I wouldn't wanna stay in a hotel that was only $96 these days. That'd be a little sus.
Well, they have apps at, like there's this app called Hotel Tonight where you can get like
Oh, really?
a nice hotel for like that.
Oh, like probably last minute things,
Yeah.
like they haven't.
Yeah.
Right, yeah, cause these days $96.
It's definitely a hotel.
Yeah, crazy, isn't it, how much it costs? So that's what's wrapped up in that CONUS rate. They also have, like, depending upon where you are in the US, there's certain areas where if you're going to there, it's higher. Like New York City, Chicago, bigger cities than that, it would be higher. And they've got this whole list of, how much it is in each location. Iowa is pretty run of the mill, like Des Moines is like, cost of living in Iowa, like they have a cost of living index, and I think the standard is, it's either 1 or 100, like that's the middle of the road, the median, and Des Moines is right there at 100, so, anyway. All right, that is travel and transportation. Questions?